Welcome to the Investopoly podcast. Our goal is to share easy to understand, evidence based, holistic insights to help you master the game of building wealth. My name's Campbell Wallace. I'll be filling in for Stuart today. What I'd like to talk to you about today is how to choose a great buyer's agent. So, we've spoken a lot about the importance of investing in the highest quality investment grade property that your budget allows. The quality of the asset you choose will likely have the greatest impact on its future capital growth rate over the long term. So, simply put, you can't expect above average capital growth from an average quality property. To ensure that you invest in the best assets within your budget, the most effective strategy is to work with an excellent buyer's agent. So, in this blog, I was hoping to outline some key qualities that I believe a great buyer's agent must possess. And before I get into those points, I just want to make one note in that good advice pays for itself and it should pay for itself. So, making a mistake when investing in property can be incredibly costly. It might take you more than 5 years to realize that you've bought the wrong asset, and by then you're faced with the time consuming and expensive process of selling. And on top of that, you'll have to cover all the upfront costs again, like stamp duty, in order to replace the investment. And even if you don't make a full-blown mistake, investing in a slightly substandard property can still cost you dearly. For example, a $1 million property growing at 6.5% per annum will be worth $3.15 million in 30 years, in today's dollars that is. But if you bought a higher quality asset that grows at 7.5% per annum, it would be worth $4.15 million. So that's an extra $1 million in equity in today's dollars. Both assets have the same acquisition costs, same loan interest, but one delivers a third more wealth. This is why investing money in obtaining expert advice from a great buyer's agent can pay for itself many times over in the long run. So it's important to invest the time to find the answers. So I'll get into it in a moment, but I've outlined 7 key factors that I believe are critical to identify a great buyer's agent. I completely understand it's natural and probably prudent to ask buyer's agents about these points to get a sense of how they measure up. However, it's important not to rely solely on their claims alone. Always take the extra step to verify this information by doing your own research online, speaking with other professionals in related industries, and getting referrals from past clients. Ideally, someone you know, trust, and respect who has been successful with building wealth as a result of this person's advice. So, the first factor we think you need to look at when choosing a buyer's agent is experience. So, specifically 10 years at least of experience, or they work in a collaborative firm. So, experience is an essential ingredient when it comes to professional advice of any kind, we think. So, with the rise of AI and the internet, there's no shortage of knowledge available, especially about property. But knowledge alone can be risky without the backing of real world experience. So, in our view, the primary reason to hire a buyer's agent is to reduce the risk of making costly mistakes, i.e., not buying the best property within your budget. The key benefit of working with a buyer's agent is that they have far more experience with inspecting and purchasing properties in the area you are interested in. They have observed how properties perform in different market conditions, and that long-term perspective helps them spot opportunities that will deliver returns over decades, not just during a short-term market boom. So the more experience an individual buyer's agent has, the more willing you should be to pay for their advice. And the reverse holds true too. Personally, we think 10 years of experience should be the minimum standard. And if a buyer's agent doesn't have that level of experience, they should be part of a team that collaborates to assess properties. But, be cautious here. Many firms operate more like sales businesses than advisory ones. So individual agents might be less inclined to work together, especially if they're competing for commission income. In our experience, smaller teams tend to collaborate really well together. So I guess the question to ask is, how much experience does the buyer's agent have? And how do they work in a team that encourages collaboration? And are multiple team members involved in inspecting target properties and deciding which ones to recommend? The next factor we think you should look for is a local area expert. So we firmly believe that selecting a buyer's agent, you should choose someone who is a true local expert, someone who has been active in the property market in that area for over 10 years. This kind of experience ensures that they have a deep understanding of the area's nuances, including trends, local amenities, and even hidden risks. Some buyer's agents offer borderless advice, meaning they purchase property outside of their home state or location. Some even do sight unseen, which is quite concerning. While strategies like hotspotting or data-driven decisions might seem appealing, without in-depth local knowledge, agents can easily overlook significant risks. These could include environmental hazards or upcoming infrastructure projects that might impact long term property values. In fact, sometimes there's no clear data driven reason why certain streets or even specific sides of the street underperforms. It's simply just a characteristic of the area. And that's something that only years of local experience can reveal. So, look, if you agree that the most valuable thing you're paying for when hiring a buyer's agent is their experience, then I guess it only makes sense that you should want them to have extensive long term experience in the specific location where you're investing. And look, I guess the absence of this experience is risky. So, the question you have to ask is what locations do you buy property in, and how long have you been operating in these markets? The next factor we think you need to look at is thorough due diligence. So, once a potential property has been identified, it's crucial for the buyer's agent to have a thorough due diligence process in place. This should go well beyond just looking at the listed price, estimated value, and the projected income and expenses. A good agent digs into all aspects of the property, including potential risks like pollution, possible zoning changes, the quality of renovations, the layout and floor plan, and the types of tenants that the property is likely to attract. This should also consider any undesirable developments, such as new infrastructure projects or issues with local amenities that could affect the property's appeal. Look, experience is key here. An agent needs to know exactly what to check to identify any hidden risks. A buyer's agent must also be transparent about these risks, even if it means missing out on purchasing a property. A true professional will be willing to reverse a recommendation if new information arises during due diligence. So if an agent isn't willing to admit, this deal might not be the right one for you anymore after investing time in evaluating it, well, that's a huge red flag if they don't. So I think the key question to ask is, what does your due diligence process include? And how do you approach pricing advice? And can you give me an example of when you walked away from a deal due to new findings during the due diligence process? The next factor we think you need to look for is the managing of potential conflicts of interest. So, look, it's essential for buyer's agents to have a clear process for managing potential conflicts of interest, especially when handling multiple clients with similar briefs. If this is particularly important in smaller competitive markets where two clients may be bidding on the same property or with the same budget, this creates a conflict of interest as the agent or the firm could be swayed by their own gain rather than working in the client's best interest. Some agencies choose not to take on new clients if their property brief is too similar to an existing one, and others operate with a strict first come, first served policy to avoid these conflicts. Either way, it's crucial to ensure that the agent's approach safeguards your interests. The next factor you need to look for is never compromising just to get a deal done. So a buyer's agent only gets paid, or mostly, when they successfully purchase a property for their client, which can create a potential conflict of interest. This financial incentive might make them more inclined to push through a deal, even if it means compromising on their advice. You want a buyer's agent who is selective about the properties they recommend and who can help you understand the true market value of those options. Their focus should be on identifying assets with strong long-term capital growth potential. A red flag for a less than ideal agent is one who constantly boasts about securing off market properties at bargain prices. Property professionals often point out that many off market deals they're overpriced or poor quality. A savvy agent won't jump at these opportunities just for the sake of exclusivity. Instead, they should be transparent about pricing and clearly explain why a property is worth the asking price, even if it's a bit above market value. So the question you've got to ask is, what's your typical time frame for finding and securing a property for your clients? The next factor is great communication. So look, clear communication is essential when working with a buyer's agent. A strong agent goes beyond just providing basic information. They offer valuable insights and they should be able to highlight potential advantages and risks you might not have thought of. This commentary should reflect their deep experience and knowledge, both of the property market in general and the local area in particular. Transparency is critical, especially when it comes to pricing, due diligence, and overall strategy. You should expect to hear the good, the bad, and the ugly. If a buyer's agent is vague or only provides minimal information, like a list of comparable sales or a basic report, it's likely that they're not offering real advice. A good agent will make sure you're fully informed, showing you both the potential benefits and risks of any property you are considering. Remember, property is both an art and a science, so you don't want all their advice and information to be purely data driven. It's just as important that they provide qualitative insights, showing their understanding of the local area and their experience in the market. So the questions you've got to ask are to ask them about recent properties that they've purchased and the reasons that they've concluded why it was a good long term investment and why it fits the client's brief. And the final factor we think you need to look for is a great reputation. So ask the buyer's agent to share examples of times that they've walked away from a property or declined to represent a potential client. We think this demonstrates strong critical thinking and integrity. A great agent's not afraid to advise clients to walk away from a property if it's not in their best interest, even after investing time and effort into the search. The decision to walk away reflects a commitment to your long-term success, not just making a sale at any cost. It shows the agent's ability to adjust their recommendation based on the new information. If an agent cannot promptly provide examples of walking away from a deal in the past, they might be more focused on closing sales than ensuring quality investments. So, look, in summary, a great buyer's agent brings together extensive experience, local knowledge, a thorough due diligence process, integrity, and transparency to help clients make smart long-term investment decisions. These agents won't just secure any property, they'll guide you towards investment-grade assets with strong potential for long-term capital growth. Getting a referral is often the best way to find a reputable and trustworthy professional who will add real value to your investment journey. Okay, I'm going to get into some listener questions now. So the first question is from Jazz. Jazz says, "Hi, I'm so glad I found this podcast. The information's so easy to consume and direct, and I've recommended it to many people." Thanks very much, Jazz. That's great. So background on Jazz's situation, he says, "My partner and I are both 43. We both plan to dial back working from 47, so in 4 years. So starting to get serious about ensuring our financial strategy is correct for the next stage of our lives." He then says, "I have a government defined benefit of about 1.4 million, in which I can draw a pension at 55 of approximately 100,000 a year and a further lump sum when I am 60. My partner only has about 40,000 in super, which we will look to bolster in the next 15 years and only access it when if required. I earn about 185,000, which will max out at maybe 200,000 over the next couple of years, and my partner is on about 40,000 a year part-time, and she's not expecting to increase that. We have 120,000 in shares, all in my partner's name. We have our home worth about 1.3 mil and 3 investment properties worth about 1.8 mil, with about 1.4 mil of debt across all of the properties. And Jazz has now given a breakdown. So there's $600,000 mortgage against the home. And then against the total 1.8 mil investment properties, just to sort of paraphrase here, they're all roughly about 50% loan to value ratio. He says our goal, 100,000 a year passive income, which we can index to inflation, taxed until 60 and then primarily tax-free post 60. This aligns with our budgeting and future expectations of spending. The future expectations, he lists traveling overseas once a year, grey nomad when we want, help the kids with the first home loan, approximately 100,000, have the home fully paid off, work when and as much as we need/want. So the questions, so he's got a couple of scenarios that he's working through at the moment. So scenario one, both reduce working at 47 to the minimum tax benefit, taking house and share earnings up to the tax-free amount, take long service leave at half pay for a year or so and travel as long as possible, return to work in some capacity from 50 to 55, and then take the full defined benefit pension, then sell properties after 60 to optimize the tax benefit, the capital gains tax, and put as much into our super funds as possible. The second scenario, continue working either in government or outside from 47 to 53, take long service leaves, sell an investment property each financial year and live off the gains as long as possible, and maximize my partner's superannuation contributions until we both turn 60, then take the defined benefit as a lump sum instead and turn it into my own pension. So my question is, we've accumulated all this based on our own knowledge, study, and our network, and sticking with a long-term strategy. What can a financial planner offer us at this point, and what questions should we be asking ourselves or a planner? So good question, Jazz. I'll answer your question directly first and then sort of look back and make a couple of comments on your situation. So I guess what can a financial planner offer us? in short, I think is the answers to your questions. And in, really assessing these different scenarios. So you've mapped out 2 scenarios here, but you've got a range of different options at your disposal. And, I think a financial advisor, a good financial planner can look at the various options and then map them out into these 2 different scenarios that you've looked at, and then offer you a third and fourth and fifth scenario. And then across all 5 of the scenarios, explain to you and show you why we think that a particular scenario is going to be the best one for you. So I think it's the answers to your question, and its assistance and its strategy for this sort of transition to retirement phase that you're in. And then in terms of what questions should you be asking yourselves or a planner? Well, yeah, I guess similar things around, experience, their investment philosophy, their collaboration with, from a holistic perspective with other professionals, because obviously, the tax implications and credit implications, you've got debt and tax implications so they're all very interconnected. So having a holistic approach, I think, is very important. Something that we talk about quite a lot is being asset class agnostic. So, you're overweight property. But you've got a mixture of property and shares and super. So having someone that's got equal knowledge across property and shares and super is important, not someone that's just focused on one particular asset class. So I think that's maybe the questions you should be asking of a planner. So just to make comment on a couple of the points in your situation here, Jazz. So I think really the obvious question is, how do you fund your living expenses? If you were to retire at 47 in 4 years' time, you could access your defined benefit at 55, which is a great benefit of these government defined benefits. You can access them earlier than the typical preservation age of super at 60 and retired. But then you've still got a gap there between 47 and 55 where you need to fund, by your calculations, 100,000 of income. So that's the big question. I mean, you've still got $600,000 mortgage, and you've probably got about 50% debt against your investment properties. Looking at kind of the locations that your properties are in, look, I won't mention them just for your privacy, but yeah, my guess would be these particular properties are probably got a good rental yield on them. So I would have it a guess that your investment property portfolio is nearing to cash flow neutral. That should be the aim. I don't think you should be trying to just pay them down aggressively, especially so when you've still got the mortgage, because that's non-deductible debt. So that should be the focus. So I probably wouldn't be putting too much more really towards paying down the investment properties. I would let them play out. I think they're probably not far off cash flow neutral. And then even still, when you draw the pension from 55 to 60, that's taxable during that period. So it's not a tax-free pension yet. So, there's still the benefits of negative gearing there. I think you mentioned at one point as well, potentially taking out the defined benefit as a lump sum. Just really against that. There's such a quality and sought after benefit that really there's not too many of them around anymore. I just think it'd be really risky. You've got a guaranteed 100,000 defined benefit there, which is also indexed. I think you've mentioned. I think it'd be not a good call to pull that out. You've got a guaranteed 100,000 indexed, which you could always fall back on and always rely upon. So there's no investment risk there. And I think you've worked hard to build up that 1.4 mil in the defined benefit. So I just can't see that would be the right thing to do. So I'd keep that there, keep that as your fallback. I think you've really then got to work around with that as your fallback, the 100,000 income. How do you then bridge this gap before 55 when you can access it? How do you get the income? How do you support your income over that period? And working the other assets to then support your income, and always just having that defined benefit as the fallback. The other general comment I'd make, Jazz, is I really don't like it when your strategy is, we try and avoid it where a strategy is just pinned on, I'll just sell the properties in 5 years or on this date, and then that will fund retirement. Pinning yourself to a really narrow time frame of which you have to sell properties is risky. Property markets move in sort of 8-9 year growth and flat cycles, and you just don't want to find yourself in a position where you're like, well, my plan was this, and now I'm going to have to sell these properties, and they've been going through a flat cycle for the last 5 or 7 years. You've really got to at least allow yourself a 10-year period to be able to strategically divest of the properties. So I don't think having really that fallback of just thinking, oh, I'll just sell the properties as soon as I retire and that will fund. So you go and I've seen it in a few examples with clients where they resign from their job and then go to sell their property or properties, and the property market's down, they can't get the value for the property, it doesn't sell, or they can't get the price that it's reasonably worth, or it seems like a really bad time to sell. So, I think you've got to really allow yourself a large time frame in which you're going to divest of the properties. I'm all for, selling the properties in retirement to fund retirement. Yeah, great. I mean, ideally you hold them for as long as possible, assuming they're great investments, and they should, and that's a key consideration is it worth holding them? Longer term, because if they're not performing up to scratch and you could sell them at a tax effective time and the timing in the market's right, then you could move those assets, into a super fund in a tax friendly environment where it's going to get a return, which I think is more guaranteed. You could look at long term performance of it. So I think the quality of the assets is important. And look, you also made a point there about divesting of the properties across 3 different financial years. I think you mentioned that's a good call, obviously, just for capital gains tax purposes. But again, whether it's subsequent years back to back, that might again just bring in a bit of sort of market timing risk, and you shouldn't have to do that. I think you'd want to spread them out as much as possible. You'd divest of the worst one first, obviously, and then hold the better ones longer, and then maybe hold on if one's really good, try and hold on to that long term. So look, these are just some general considerations. Jazz, there's probably a bit to work through there, but look, I hope that helps. Okay, the next question is from an anonymous listener. They say, love the podcast. I've recently finished and read your book, and as an avid listener, I feel as though a lot of questions that come through are suited towards a slightly older audience. So I want to see what I can do, as I'm still a young-ish person and starting out. Well, it's probably good that I answer this question because I'm not as old as Stuart. So this person goes on to write, I'm 25, healthcare worker with a stable income. I'm making 120 to 160,000 with overtime. I placed a 5% deposit down on a $645,000 apartment several years ago, which should be completed in just over a year. I value lifestyle and location and travel times, so it's suited for this. The apartment is in a blue chip suburb in Adelaide, 2 bedrooms. I have just over 45,000 in super, already salary sacrificing, and 250,000 in a HISA, or high interest savings account, I'm guessing that is, split between ING and UBank to maximise my interest. Obviously impacting my taxable income, that interest is. When my apartment is ready, I'll be entitled to no stamp duty and a $15,000 first home owner's grant. I know your book described investment grade property, how it describes investment grade property. However, I believe mine would be in the lowest tier, which I'm okay with for now. I anticipate that I will have just over 100K left over after putting the rest of the 20% deposit down to avoid LMI, lender's mortgage insurance. So this gives me roughly this year to maximize my savings. I would like to get into shares again. In brackets, I sold my shares to fund my deposit. Probably should have held on to these. I would like to start investing in DAHHF on the Beta Shares Direct, no brokerage in brackets. So that's a share investing platform run by Beta Shares, and DAHHF is the ticker code for a diversified growth fund run by Beta Shares, just for context. Obviously, property is not all that's talked about. However, I don't want to use my remaining savings and buy another property and be cash poor, and wanted to better diversify myself. How can I best split my income to both save and build a share or ETF portfolio without being eaten alive by brokerage fees? I've been fairly high risk appetite. My goal is to purchase another property in the next 3 years and keep the apartment as an investment. I'll be putting the remainder of my funds into an offset account for the apartment, or should I focus more on my savings? Thanks. So, anonymous listener, the first thing I'll comment is, so look, if you're going to be left with 100,000 after putting the final 20% deposit down to avoid lender's mortgage insurance, which I think is a good idea. So you're going to be left over with 100,000, and you then go on to comment about, my goal is to purchase another property in the next 3 years. And you also mentioned about liking to have flexibility and lifestyle and that sort of thing. Then talking about investing in the share market, which is what you'd be doing with the Beta Shares Direct fund, I don't think that I'd be doing it. Look, I really think with when you're early on in your career and your life and your strategy and your plan, I think it's really about securing the large assets first, and getting those large financial assets under the belt first, and then sort of once that settles, then distributing your surplus cash flow into some debt reduction, potentially some regular share investing as well. But I think given that's within a 3-year period that you like to purchase another property, that's too short a period, I think, to go and park the money in an index fund through Beta Shares in the share market and hope that then you're going to make good returns on that, and then use those funds, pull them out, and then put them towards the property. It's risky. I mean, like 3 years, it's just on the threshold. I think, if you look back at the last sort of major drawdowns in the market, like COVID or GFC or 2022 with the interest rate rises, those drawdown periods, usually they've been pretty quick to recover. So even if you were invested for a year or two, but GFC, I think you needed at least 2 years to recover the money that you've lost. So really that kind of dictates the time frame. You've got to have a certain time frame when you're investing in shares. So I think given that if there's a goal to purchase another property in the next 3 years, which I think is great, I think that's a good call with, your stage of life. I don't think I'd be investing just yet. I think I'd be parking the money in the offset account, getting a guaranteed 6.5%, on your mortgage, keeping that, having that flexibility, and also 100,000. You want that as buffer. I think everyone's got to have a bit of a cash buffer on hand. I think, going and taking that 100,000, investing it and leaving yourself with no cash buffer, that's risky. I don't think I'd be doing it. So look, to you, I think I'd just let the development of this new apartment that you're getting play out, get the deposit, let that all settle. And then I think I'd just be parking the money in the offset account. That's the best savings mechanism because you're getting a 6 to 6.5% return. So that's going to be better than your ING or UBank returns with the high interest savings account. An offset account for a non-deductible loan is a great savings mechanism. So I think I'd do that if I was you. I hope that helps. Okay, the next question is from Jazz. Okay, it might be the same Jazz or it might be another Jazz, but anyhow, Jazz says, I'm looking for options to easily diversify our investments as we are heavily Oz concentrated, Australian share market concentrated, that is, and I was hoping to use existing funds such as via super so it could be done in a timely manner. I'm guessing he means there, so he doesn't have to build up, the savings over time. He's got the existing funds there. One of our super funds provides various investment options. Question: when is it appropriate to use a super fund option such as International Shares Unhedged Index from Q Super as part of your super investment mix? So look, Jazz, I think when is it appropriate? Look, I think it depends what allocation you're talking about. I think that there should always be in a share portfolio or a super fund an allocation to the international share market. We talk about typically if most portfolios in Australia, like industry super funds, it's about sort of 60-40 or 50-50 split of the shares in the Australian share market and the international share market. But if you kind of think about it, the Australian share market makes up about 2% of the international share market. So you're putting 50% of your portfolio in 2% of the global market. So I think, having a higher weighting to the international share index is more prudent. I mean, there is, of course, benefits such as franking credits and there's higher dividend, higher yielding in the Australian market. So there's some tax benefits there. But look, so I think when is it appropriate? I think it's always appropriate. But maybe if I could just make a comment in the particular option that you're looking at, the International Shares Unhedged Index. So that is a market cap weighted index. So that's going to be very heavily skewed to the top end of town. So the large cap stocks. And if you look, the US makes up about 50% of the share market. And of that, it's very heavily weighted to the top 7 stocks, the Magnificent 7 that you've probably heard of. And they look very hot and overpriced and overvalued, we think. So I'm just hesitant in putting a large amount. I wouldn't be swinging a large amount of a portfolio into a market cap weighted index fund like that option that you're talking about, because you're going to be putting a lot of weight into those ones in that particular part of the market. And then I guess if I can make a comment about timing of unhedged, I don't really think it would be the best time to go unhedged. I think it's probably more of a time if you had to make the pick. I mean, picking currencies and currency trading is one of the most difficult things. But I think if I was to make a call, you'd probably be more inclined to go a hedged option at this point. So the hedging hedges you against the currency rate. So, I mean, the Australian dollar compared to the US is currently at about 64 cents. So it's about 64 cents to the dollar at the moment. It got down a little bit earlier this year down to a bottom point, a low point of about 61 cents. But look, that's really on historical long-term averages. That's quite low. It historically trades more up around sort of, 65 cents, even maybe up to 70 cents at a very high point. So I probably wouldn't be putting a lot of weight into the unhedging. So if there's a hedging option there, I think that would probably be more prudent at this point. And look, maybe just the other comment I'd make, Jazz, is that I like your philosophy in that you're looking at your overall wealth as a whole. A lot of people don't do this. I think they just get focused on, here's the super portfolio, what's the asset allocation of that? Here's my share fund, what's the allocation of that? Here's my property portfolio, what's the allocation of that? So it's good that you're taking that holistic view of your overall. And I think there's some good strategies that you can use in there. So, by different asset classes have different attributes. And international share funds should typically have more of its return from growth and less from income, as opposed to an Australian shares. They should have a little bit more dividend yield and then slightly less growth historically. So I like that you're taking that overall look at it. So I guess it would be fine it could be okay just to be in the international shares index fund, because that's still very diversified from an asset allocation perspective. But you'd want to weigh it up with the other investments that you have in your personal name. And I think you still do want some Australian exposure there, because I think the Australian share market it's more undervalued and it looks at better value, I think, than the US share market at this point in time. So I like that you're taking that overall view. And as long as you've got some other exposure asset allocations, I think that would be a good thing. Okay, and I've probably got time for one more quick one before I wrap things up. So, hi, I'm a long-time listener of your podcast. Really appreciate the valuable insights you share. I recall you mentioning approximately 2.8 million in investments is needed to establish a perpetual portfolio. Could you please elaborate on this figure? I would love to understand the assumptions behind your calculations and how you arrived at this amount. I recognise that this figure may vary for each individual or couple, and I believe many of your listeners would aspire to reach or exceed this target. Your insights on this scenario would be greatly appreciated, and that's from Tim. So Tim, look, simply put, a short answer to it is a perpetual portfolio is one that doesn't dilute its capital. So you can draw upon it and it either maintains its capital or continues to grow. So I think in Stuart's example there, at $2.8 million, I'm guessing his assumption was around what someone would be drawing upon it. So if we assume, 2.8 million, if you get a 7% return, that's 196,000 of, a mixture of income and capital growth, but it's really return or performance off 2.8 million from a 7% return. So if someone, is then living off 100,000 or 150,000 or all of that 196,000, in theory, the perpetual portfolio, you'd either be maintaining the capital or the capital would be continuing to appreciate, because you're only drawing upon the returns. I hope that it sort of explains it for you. Okay, that's all the time I've got for today. Thanks for listening. Bye for now.
Just a few things before we wrap up, if I may. Of course, you can send me questions at questions@investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.